The Fear and Greed Index is deep in extreme fear territory. We are talking about readings in the single digits to low teens. These are the kinds of readings that have historically marked capitulation zones. 6 of the 7 indicators tracked by the index are now in extreme fear. The last time readings stayed this low for this long, markets were bottoming during the 2022 bear market. The volatility index has been hovering in the high 20s to low 30s. That is roughly 33% above its long-term historical average and the highest sustained level in nearly 2 years. The volatility index, often called the VIX, has been hovering in the high 20s to low 30s. That is roughly 33% above its long-term historical average. The Standard & Poor's 500 has now fallen for 5 consecutive weeks. Brent crude is above $110 a barrel. Oil prices are flashing inflation warnings. The Federal Reserve is staying on hold for now. And the market is asking one question right now. Is this the buying opportunity, or is there one more drop coming? Today we run both scenarios. Scenario A is why extreme fear historically signals a rebound. Scenario B is why this particular fear environment is structurally different. Before the scenarios, here are the facts. The Standard & Poor's 500 is trading near 7-month lows. From its recent high, the index is down approximately 7%. But that headline number disguises a much uglier reality underneath. The average stock in the Standard & Poor's 500 is down approximately 17% from its high. The average stock in the Nasdaq is down approximately 31%. The indexes have held up relatively well. Individual stocks have not. Here is what is driving the fear. 3 triggers are running simultaneously. First, the Iran conflict. Operation Epic Fury launched in late February 2026. The Strait of Hormuz has been disrupted. Oil prices surged on day one and have stayed elevated. Brent crude is hovering above $110 per barrel. Second, President Trump's 10% global baseline tariff, implemented in early 2026, is creating uncertainty across supply chains. Companies with heavy international exposure are seeing margin compression. Corporate earnings estimates are being revised lower. Third, the Federal Reserve is staying on hold. Chair Jerome Powell has kept the federal funds rate at 3.5%. Energy-driven inflation is keeping the Federal Reserve from cutting rates even as growth slows. The market is pricing in a scenario where rates stay higher for longer, while corporate earnings come under pressure. 3 simultaneous headwinds. That combination is what pushed volatility higher and fear deeper. Scenario A is the case for buying into this fear. The data on extreme fear is consistent. When the Fear and Greed Index drops deep into extreme fear, markets have historically delivered above-average returns over the following 12 months. The current reading matches the psychological extremes seen during the coronavirus crash of March 2020 and during the 2022 bear market lows. In both of those cases, the bottoms were formed during the extreme fear period, not after it passed. On March 6, 2026, the volatility index closed at 29.5. Research shows that when the volatility index closes above 29, the Standard & Poor's 500 has historically advanced over the following 12 months. Wall Street's current bottom-up consensus implies the Standard & Poor's 500 reaching approximately 8,338 by March 2027. That is roughly 27% upside from current levels. The argument for buying now is structural. War news is already in the price. The initial panic move typically overshoots the fundamental reality. Earnings are being revised but not collapsing. The technology sector's forward price-to-earnings ratio is now at 20.2, down from 31.7 just 5 months ago. That is the lowest valuation level in 3 years for the sector that has been driving market returns. Historically, markets do not wait for the fear to clear before they start moving. By the time the Fear and Greed Index recovers to 50, the entry opportunity is typically gone. Scenario B is the case for waiting. This particular fear environment is structurally different from previous extreme fear episodes. This is sticky fear. The volatility index is not spiking to 50 and recovering. It is sitting in the high 20s to low 30s for weeks on end. That sustained elevated volatility signals that the uncertainty is structural, not emotional. Oil above $110 per barrel is not just a fear trade, it is an economic constraint. Energy-driven inflation historically feeds back into consumer spending, corporate margins, and eventually earnings. If Brent stays above $100 for an extended period, the Federal Reserve cannot cut rates. And if the Federal Reserve cannot cut rates, the multiple compression on equities continues. The Standard & Poor's 500 remains in a technical downtrend below its 200-day moving average. Technical support is not evident until the 6,200 level. A break below that would represent a further 6% decline. Corporate earnings reports for the first quarter of 2026 begin in April. That is the first time we will see real data on how the 10% global tariff is hitting margins. If earnings disappoint, the market has another catalyst for a downward move. Here is the honest synthesis. Both scenarios are valid. What the historical record shows is not that extreme fear always leads to immediate recovery. It shows that extreme fear leads to above-average returns over a 12-month horizon, but the path is often bumpy. Extreme fear marks a zone of opportunity, not a precise entry point. At what level of fear do you begin building a position, and how do you survive a second flush if it comes? Deep in extreme fear, the data says you are closer to a buying opportunity than at any point since early 2023. But a second flush to 6,200 remains a live scenario. The investors who outperform are not the ones who perfectly time the bottom. They are the ones who begin scaling in during extreme fear. Here is the practical signal. Watch the direction of the volatility index, not just the level. A sustained move below 20 signals risk appetite returning. Watch the direction of Brent crude. A sustained move below $90 per barrel signals the market is pricing in resolution. Watch the Standard & Poor's 500 and its relationship with a 200-day moving average. A close above 6,633 would confirm the downtrend has broken. Those three signals together would confirm that fear is resolving. They are not there yet, but they are the map. Here is the summary. The Fear and Greed Index is deep in extreme fear. The Volatility Index is elevated. The Standard & Poor's 500 is below its 200-day moving average. Brent crude is above $110. The Iran conflict remains unresolved. The tariff headwind remains in place, and first quarter corporate earnings reports arrive in April. The bull case is that extreme fear has historically produced above-average 12-month returns. The bear case is that this fear is structural, not emotional. The honest answer is that the zone of opportunity is open, but the path is not a straight line. Same pattern, different trigger, same data. If this breakdown was useful, please press like. Share your view in the comments. Subscribe and turn on notifications. This is market commentary and historical data analysis only. It is not a buy or sell recommendation. See you in the next one.